All right, everybody, these are the final video modules of the semester. And so what these are going to cover are the slides on behavioral finance. So the first part of this slide deck covered the efficient markets hypothesis. We covered that in class. And so these slides will be covering the behavioral part of the lecture. And so these are for the students in the Thursday night WPMBA class, which will not have a class meeting because the semester officially ends on Wednesday. And also, that could also be true that these video modules are also for students in the Tuesday class who, knowing that these video modules will exist, have chosen not to attend the Tuesday class. No worries. All right, so what we're going to talk about here are the various cognitive and behavioral biases that actually might lead investors to making suboptimal decisions and how that might affect the pricing of stocks, bonds, etc. in our markets. So the behavior of individual investors, some of the things we see in the data is that we tend to not diversify well enough. Now, hopefully you won't fall into this category, haven't taken this class, but we do seem to find that a lot of investors have very concentrated portfolios, and they also have a home bias, which means U.S. investors tend to own U.S. stocks, Australian investors tend to own Australian stocks, investors in France tend to own stocks of companies in France, and even at the more micro level, we have a home bias at home. So if you live in Columbus, Ohio, you have a greater tendency of owning stocks of companies domiciled in Columbus, Ohio, or in the state of Ohio than you would relative to stocks domiciled in other states. So what this means is that, yeah, we're going to have a diversification that's suboptimal. We're not going to be as broadly diversified across the investing landscape as we should. Another thing is we see the disposition effect. And so what this means is that we have a strong urge to sell stocks that have gone up in value, which means we may be selling them too soon because they actually might continue to win in the long run. We also tend to hang on to losing stocks a little bit too long because what that means is we don't want to admit our mistake. I buy a stock at 50 and it goes down to 25. Well, I try and convince myself that, oh, yeah, I shouldn't just write off the loss and move on. Instead, I should hang on to it. In fact, maybe even buy some more shares of it so that I average my buying price down because I'm so convinced that this is a good investment. Well, sometimes investments just don't work out. And so after a period of time, you may be best served by saying, you know what, I'm going to cut my losses, take the cash, and move on to some other investment. Another thing we see is excessive trading and gambling behavior, and these two very much go in tandem because if you're overconfident, what that means is that you think you are better than average, and as a result, the trades that you make are more likely than not to earn you a positive alpha. And so quite often this sort of ties well in with gambling behavior, is that you get a thrill out of doing this, and that actually pushes you to take on a little bit more risk and to do a little bit too much trading. So if you get a thrill out of investing and the risk taking that comes with it, well, then quite often that might lead you to making suboptimal decisions. You're trading for the thrill rather than for the betterment of your portfolio. So if we look at the performance of individual investors, looking at their portfolio turnover, all right, so this comes out of some very important research that came out almost 20 years ago now. And so these two researchers, Barbara and Odine, got a hold of a bunch of Charles Schwab data. And so they sorted all of this individual investor data of these Charles Schwab accounts by the amount that they trade. And so what they found was that if you look at the left-hand bar there, quartile or quintile 1, that is the quintile of investment accounts that did the least amount of trading. And you can see there on the y-axis of annual return, those portfolios tended to do the best. Now, which portfolio did the worst, or which quintile of portfolios did the worst? Over there on the right, the ones that had the most turnover. So what this implies, as you can see in the title of the paper, trading is hazardous to your wealth. The investors that did the most investment trading almost categorically were trading too often. They were taking on too much risk. They generated too much trading costs with their trades, and at the end of the day, harmed the overall result of their portfolios. Now notice that red bar, which is the S&P 500 there, only quartile 1 investors, those that had the lowest turnover, actually were able to eke out a slightly higher than average annual return than the S&P 500. If you look at quintiles 2, 3, 4, and 5, what you find is that the more investors trade, the less likely they are to match up to an index like the S&P 500. Some other things about trading biases. So your mood, your attention, your experience is that individuals will tend to buy stocks that have been recently in the news. So think about this in the context of IPOs, right? If LinkedIn's IPO, Facebook's IPO, any IPO that's out there, if it's in the public domain, there's a lot of coverage going on that day or that week, well, that may make the average investor slightly more likely to buy it because it's sitting there in the news, it sounds interesting, it sounds exciting to them, and they think to themselves, well, maybe this would be good in my portfolio without actually thinking about the underlying fundamentals of the stock and how it fits in their portfolio. Some other things we see, mood also affects how we invest. And so just one example of this is that if the day is sunny outside, investors are a little bit more optimistic with their trading activity. So if, for example, if it is sunny on Wall Street in lower Manhattan, it turns out to marginally increase the likelihood that the stock market will go up that day. Now, there's no fundamental underlying reason for why there should be any correlation between the two, but we do see that in the data. Some other things, investors tend to put too much weight on their own experience. Well, this sort of ties into the idea that when we gather information about investing, the rational expectations hypothesis says that we're going to use all of that information exactly in the best way that we can to optimize our decisions. However, our own personally gained investment information, that's what seems to stick with us the most closely. So think about investors that put money into the market in the late 1920s and then were burned by the collapse of the stock market and the Great Depression. My grandparents fell into that category, and for the rest of their lives, they were very scared of investing in stocks, even though over the course of their lifetimes, they lived well into their 80s. Owning stocks would have done a great deal for their financial security and financial independence. However, they were pretty much bond investors because they had been so scared and so scarred by their experience owning stocks when they were young. So when people grow up, if we look at this from the opposite perspective, if people grow up during a period of time when the stock market's doing really well, then people, well, at the other end of the spectrum, have a little bit too much exuberance over investing in stocks. They will underestimate the potential for bad things to happen. Some other things we see among individual investors, there's herd behavior, is that if the market is powering up or trending down, whichever the case may be, what we do is what we see is a lot of investors just follow what other people are doing. And so what that means is that categorically people are going to be making the same trading errors. So when the market was collapsing in 2007, well, a lot of people were selling. That's a big reason why the prices were going down. And so who did the best during that period of time? The ones who did not panic. So people that actually had cash to put into the market as the market was falling, if they were investing and buying those stocks when they were at their lows for the last few years, well, those are people whose portfolios did very, very well over the subsequent decades. So if you had money to invest and you put it into the market in 2008 when things were bottoming out, well, perfect example to do that, right? Buy low, sell high. It's exactly what you want to do. As Warren Buffett once said, and I may be getting the words off a little bit here, is that you want to be greedy when others are fearful, and you want to be fearful when others are greedy. Some other things from individual investor data are informational cascade effects. And so, again, this sort of ties into herd behavior in a little bit, is that we ignore our own information, hoping to profit from the information of others. So I'm looking at investing in a stock, and it looks like a good company to me, but it turns out it's a bad day for that stock, and everybody's selling it and driving the price down. I tend to distrust my own information, and I say, boy, all of these other people are running for the exits. That means I better run for the exits too, because there must be something I'm missing here. Well, that doesn't always end up being the case. Some other things about behavioral biases, if we kind of summarize these last few slides, well, if individual investors are falling victim to these biases, as a result, what are they probably doing? They're probably earning negative alphas in their portfolio. And so if that's the case, well, if we're being introspective about our behavior, then what that means is that we are the ones getting fleeced by more sophisticated investors if we are falling victim to these cognitive and behavioral biases. Now, of course, one remedy to that is to say, okay, if we don't fully trust ourselves, or we don't fully trust our information, or just simply don't have the time to gather a lot of information, we can always own a portfolio of index funds, in other words, passive investments, and earn an alpha of 0, or very, very close to it at least. So let's say we wanted to sort of get an example, a numerical example of how investors think about this. This is called an anchoring bias that we're going to talk about here. So Mr. Schiller bought his home in 1996 for $180,000. There's no mortgage on the house. Now he is moving out of the area, and yesterday he got an offer to sell it for $230,000, which reflects the current market price. Should he sell his home? Well, when people were surveyed, with this question? The majority of them said yes. You can see the blue bar there, so slightly more than 50% said, yeah, he should sell his home. He bought it for 180 and now it's 230. But if we were to sort of change the parameters of this around slightly, now we say, okay, Mr. Schiller bought his house in 2006 for $340,000. Now he's selling the house, there's no mortgage, and he got an offer for $230,000. Should he sell his home? Well, you can see there that now the percentage of people who say yes drops dramatically. And so what are they doing? They're comparing the current market price, which is $230,000 in both cases, to the original buying price. Well, that means this is an example of what we call an anchoring bias, is that the purchase price that we buy something often anchors our behavior on this. So in the initial example, you say, yeah, we're selling at a gain, so of course we should sell. Whereas in the second example, well, to do that, we'd be selling at a loss. We shouldn't do it. Well, while that might be our inclination, right? At the same time, if you need to move out of the area, well, you need to sell your house in most cases. And so what that means is you just look to get the best price relative to the market value that you can, you sell, and you move on. So this idea that you somehow shouldn't sell a house that you need to sell just because it's priced lower than when you bought it, well, that's an example of this anchoring bias. So some other things about market efficiency and what we would refer to as the limits to arbitrage. Okay, so let's say because of these behavioral biases or because of other just exogenous reasons, let's say prices don't match what their true intrinsic value is. Well, if that's the case, then very smart traders that we might just call arbitrageurs, people out there looking for a riskless profit, they should be the ones who are working hard to eradicate those price differentials. Because if I'm an arbitrager and I see a stock priced at 60 and it really should be priced at 70, well, then I'm going to buy it and I'm going to keep buying it, and my fellow arbitrageurs, we're going to keep buying it until that price gets back up to 70, at which point we might sell. So we earn the profit based upon that mispricing, and we also, while looking out for our own best interest, actually serve the public a little bit in the sense that we are pushing prices back to where they should be, their most efficient value. Now, on the other hand, let's say I'd like to do this, but I'm prevented from doing so. So this is what we refer to when we talk about limits to arbitrage. So one example of this is short selling constraints. So let's say I'm a mutual fund manager. Mutual fund managers generally seen as being, pretty sharp, definitely people that have studied finance and have a lot of experience in finance. However, a lot of mutual fund managers are restricted by their investors and their investment companies from short selling. And so if I see a situation where a stock is priced at 70 and it should be at 50, well, I could actually make money by doing what's called a short sale. However, if I'm prevented from doing that, well, then that means I can't engage in that activity. I can't make money and also push that price back to where it should be, which could mean that mispricing actually maintains for a long period of time. Other things that are limits to arbitrage are transaction costs, right? It costs me money to trade. It costs anybody money to trade. So if I see a mispricing, but it's relatively small, well, then I may conclude that my transaction costs are just going to eat up the profit. So if I say something's priced at 40 and it should be priced at 41, well, I say, you know what, the cost of me trading to actually take advantage of that would wipe out the $1 gain. So as a result, small mispricings may maintain over longer periods because of transaction costs. Other things out there, if I have a need to report to investors, well, that way what this means, if I have a little bit of risk aversion, I'm a little worried about making a wrong decision. Arbitrage is defined as a riskless profit, but very few things are actually riskless. Then in that case, maybe I don't pull a trigger quite as often as I would if I was just reporting to myself. And so as a result, there may be some mispricings out there that don't get pushed back to where they should be, simply because there are some investors out there just not willing to actually make a trade. Then finally, some other things, fixed costs of generating information and capital constraints, basically just two other frictions that essentially create costs to try and locate and figure out where these mispricings occur. And if I only have so much money to go around, well, then all of those things are impediments to me actually taking action on these potential arbitrage opportunities. So if we have high limits to arbitrage, let's say capital constraints are very important, transaction costs are high, or let's say short sale constraints are very binding, well, then that means that the price of, let's say, a stock can actually vary significantly from its fundamental or intrinsic value before it's profitable enough to sort of push that price back to where it should be. On the other hand, if we have low limits to arbitrage, well then as a result what that means is that, well, that price should only be off its fundamental value by a tiny amount before people are able to jump in and push that price back to where it should by profitable trading activity. And so what we want to see in our markets, we want to see low limits to arbitrage because that helps keep prices as close as possible to where their true intrinsic value actually is. All right, the final thing in this segment, so talking about limits to arbitrage, well, just to follow up on what we said on the last slide, if mispricing is difficult to arbitrage, then that does mean that prices will be noisier. And so what that means is that, yeah, they're going to be pushed off or pushed away from their fundamental values because various bits of information which really shouldn't be relevant actually are effective in nudging the price off of its fundamental value. That's just another way of saying is that it's going to be noisy out there, is that prices are not going to reflect all of the important information at all times, is that more ephemeral bits of information may actually nudge the price away from its true value. Another consequence of this is that if mispricing is difficult to arbitrage away, that we may find that stock prices have systematic or predictable patterns. So if this occurs in a similar fashion over time, then that may mean that stock prices actually move in pricing patterns up and down that we can track and then use that to predict future pricing patterns. This would be a violation of the weak form of market efficiency. However, as a result, this can be a situation where we see prices that are off their true value but actually stay that way for the long term as a result of not being able to arbitrage them back where they belong.